Picture the whole market splitting into two camps, the companies writing enormous checks for AI and the companies cashing them. Today, only one of those camps got paid. I'm Onyx.
And I'm Nova. Hey everyone, welcome back to the Working Thesis. It's Monday, June 22nd, and honestly, this was one of those days where the headline number tells you almost nothing, and the story underneath tells you everything. Grab your coffee. Let's get into it. Quick note. The Working Thesis is personal market commentary for education and entertainment only, not investment advice and not a recommendation.
We mention companies as examples of a theme, never as buy or sell calls. Do your own research and make your own decisions.
So if you just glanced at the S&P, down about 0.4%, you'd think, sleepy Monday. Under the hood, though, not sleepy at all. The Dow closed green, the Nasdaq fell more than 1%, and the chip index ripped to a brand new record.
And that combo is the tell. Value up, big tech down, semis at all-time highs. That's not fear, that's a rotation. Money didn't run for the exits, it changed seats. The VIX barely budged, still parked under 20. Nobody panicked, they just reshuffled the deck. Quick scoreboard, so you've got the numbers. The Dow finished near 51,700, up about 0.3. The S&P just under 74.73, down 0.33%. The Nasdaq, 26,000 and change, off 1.3.
And the star of the show, the semiconductor index, the SOX, up 2% to a record 14,600. So while the giants stumbled, the chipmakers threw a party. Hold that picture in your head, because the whole episode is basically explaining it. Let's start with who got punished, the spenders, the names pouring the most into AI. Alphabet led the drop, down about 5%, after reports that yet another DeepMind researcher walked out the door to join the rival lab Anthropic. The AI talent war is real, and it is expensive.
And it wasn't just Google. Amazon down nearly 5, Microsoft off 3, Meta down a couple, Broadcom almost 5. Here's the line one analyst used that stuck with me. Nothing about these companies actually changed today. The market just suddenly started counting cash flow and debt again. When money's loose, you pay for the story. When it tightens, the exact same story gets a colder look. Now flip it, who got rewarded? The suppliers. The picks and shovels crowd. Micron, the memory maker, jumped about 7% to a record, on reports of a long-term memory deal with the AI lab Anthropic, and it reports earnings Wednesday, so that's a big one to watch.
And the supporting cast all showed up. Intel up 5, Lam Research up over 5, Applied Materials up almost 4, AMD up 2. Then there's my favorite data point of the day. South Korea's chip exports in the first 20 days of June were up 60% year-on-year. Semiconductors are now about 40% of the whole country's exports, up from 18% just a year ago. That's not vibes. That's an entire country's customs data yelling, AI hardware. Here's the part that genuinely surprised me. We think of the Magnificent Seven as the market, but in 2026, they're lagging. As a group they're up only a little, behind the S&P by roughly 9%, and way behind the Nasdaq.
Which, if you've been around a while, is kind of wild. It's the first time since 2015 that the Mag 7 underperform in an up year. One commentator drew it as two lines. The check writers in red, the check cashers in green, steadily pulling apart. Pay to spend is getting punished. Pay to build capacity is getting paid. Today just made that chart impossible to ignore. Quick trip around the globe, because Asia actually had a good day. Mainland China was strong. Shanghai up about 1.8%, Shenzhen up over 2. Taiwan was the standout, up nearly 3%, surfing that exact same chip wave.
Hong Kong was the odd one out, down about 0.5%. But broadly, the AI hardware bid that lifted our chip index was a global thing today, and it showed up loudest in the places that actually make the stuff. Funny how that works.
Oh, and a couple of quick global headlines while we're here. The UK Prime Minister actually resigned over the weekend after only about a year on the job, and the market basically shrugged. The pound didn't blink. And on trade, a batch of US tariff decisions are up in the air this summer, with some smaller economies possibly catching a break. Nothing market moving today, but both are worth keeping on the radar.
Over in commodities, oil took a real tumble. Brent dropped more than 3%, back under 80. U.S. crude off more than 2. The trigger. A constructive round of Iran talks. There's now a direct U.S.-Iran channel, plus a 60-day waiver on Iran oil sanctions, which lets a lot more barrels flow. The read at the desks is that a near-term top in oil is probably in.
Meanwhile, the dollar hit a one-year high. The market's reading the Fed chair as hawkish, and that leaned on gold, down about 1% to around 4,150. Quick thesis note, because gold's one we track. One big bank just went long-term bullish but short-term cautious, and central banks are still buying. A recent survey had a record share of them planning to add gold this year. So, near-term headwind, long-term floor. And the 10-year yield held firm around 4.5. So after a sell-off like this, the obvious question, are the big spenders cheap now? And the honest answer is, it depends, and you have to read each one against its own history, not the market's.
So here's the read. Meta's down near 14 times forward earnings, a 3-year low, because the market's betting a chunk of its past AI spend was wasted. But if its margins hold above 40%, that's the one that can snap back. Microsoft's at a fresh 5-year low around 19 times, with margins still intact. Arguably the cleanest of the bunch. Google's around 24, reasonable, not cheap. Amazon near 25, the most room left to fall. And the kicker. Nvidia is trading below the S&P's own multiple. The defining franchise of the AI era, cheaper than the index, and it still lagged today. Cheap and unloved at the same time.
Let's zoom out, because today was the clearest single-day snapshot of a theme we talk about all the time. In the AI build-out, the cash keeps flowing to the scarce suppliers, the memory, the chip-making gear, more than to the giants spending the capex.
Today the tape basically highlighted that idea in neon. But, deep breath, it's one day. One day is noise, not a trend. Rotations can flip right back by Thursday. We're not crowning a winner here. We're just noticing that today, the market paid the suppliers and side-eyed the spenders. And we owe you the other side of this because it matters. Own the inputs sounds clean, but the suppliers only get paid as long as the spenders keep spending.
Right. The hyperscalers are the buyers. If their AI doesn't start paying off and they pull back on capex, here's the asymmetry that's easy to miss. The giants can just cut spending and coast on their cash cow core businesses. They bounce back in a couple of years. But the suppliers riding that spending, they might not recover for a lot longer. So the input names are where the cash is now. They are not a free lunch. The whole chain leans on those checks clearing. Which brings us to the thing we keep flagging, how this whole build is being paid for. More and more of it is debt. Issuance of AI infrastructure credit is up around 350% year on year. Hundreds of billions of dollars. Hyperscaler leverage has roughly doubled in a year.
And get this, even Nvidia, which is basically swimming in cash, issued about $25 billion in bonds. When the most cash-rich company in tech borrows, you raise an eyebrow. There's even a jobs angle. Companies are picking capex over headcount. One big software firm cut its workforce by over 10%, partly AI-driven, and tech layoffs this year are up sharply. The machines are getting the budget, some of the people aren't. That's the financing risk marker we keep our eye on. Now, if semis are this year's winners, the clear losers have been software. And that's not random, it's our second thesis playing out in real time. Some of the worst performers in the entire S&P this year are software and IT services names. Adobe down over 40%, Salesforce down over 40%, Accenture roughly cut in half.
And the story there is agentic AI, the fear that when an AI agent does the work, you stop paying for a seat. The classic software model, add one more user at basically zero cost, then bill them every single month, is exactly what the market's nervous about right now. We did a whole episode on it. Today just added more receipts to the pile. Okay, here's the nerdy but important twist, and it might be the most interesting thing happening under the surface. Part of today's megacap wobble was some chatter that the short-term, by-the-hour price of renting AI chips had ticked down, and a few folks spun that as AI demand is finally cooling.
But that's probably the wrong read. Demand isn't dying, the economics are just getting smarter. Running top-tier AI agents is genuinely pricey. One company reportedly torched its entire annual AI budget in 3 months and slammed the brakes. So everybody's optimizing and hunting for cheaper compute. Open-source models are catching up fast, There's a Chinese open model reportedly around 80% as capable as the Frontier. And even Microsoft is said to be leaning on a cheaper open model to make its Copilot agents actually affordable to run. So the takeaway isn't demand is slowing. Its demand is getting cost-conscious and spreading out. Optimization and diversification, not a peak.
And there's a reason everyone's fighting so hard over this. The first thing AI got really good at was coding, and replacing software engineers is what, a couple $1 trillion salary market. That's the prize. But here's the catch. Once one lab cracks it, the others catch up fast. A rival's coding tool reportedly already pulled even, and those open models are right behind. When everyone's good at the same thing, pricing power evaporates and it turns into a price war. Which again is great for whoever's buying the AI, and harder for anyone hoping to sell it at a premium forever.
One more headline that's easy to miss in all the AI noise. The White House signed 2 executive orders pushing quantum computing. One aiming for a research-grade quantum machine by 2028, another to finish upgrading the nation's encryption by 2031. IBM popped about 5% after hours on the news.
Fun reality check for the skeptics. IBM itself doesn't expect a truly fault-tolerant quantum computer until around 2029, and most others later than that. So it's early, like very early. But you know how it goes. When the White House signs the order, the stock goes up first and asks questions later. File it under watch and see, given how early the tech really is. 2 things to keep us honest on all the bullish stuff. First, breadth is thinning. Only about 54% of the S&P is above its 50-day average, even as the index grinds higher. Fewer and fewer stocks are carrying the load, and that kind of divergence often shows up before a wobble, not after.
And the market is seriously top-heavy. The 10 biggest names are about 40% of the entire S&P. So the index basically can't dodge a pullback unless those megacaps hold the line. One handy rule of thumb traders use. The dip buyers tend to keep buying right up until the VIX gets near 30. We're under 20, so for now the buy the dip crowd is still showing up to work. Here's a genuinely useful seasonal nugget. A lot of this week's selling is mechanical, not emotional. It's month-end and pension funds, sitting at their healthiest funding levels in decades, are rebalancing, trimming stocks, topping up bonds.
But that flow tends to flip around July 1st, when fresh contributions and passive money come pouring back in. And the seasonality is striking. Since 1928, the S&P has been up in the first half of July about 69% of the time. The Nasdaq's been up 17 of the last 18 years. It's a probability, not a promise, but it's a tailwind worth knowing about. One desk even noted its clients dumped about $6 billion of the Mag 7 over 20 days. Heavy late selling that usually clusters near exhaustion, not the beginning of one. Quick, slightly older sibling moment, because it's been on our minds. The rotation we just walked through? That's smart money being thoughtful. But there's also a lot of not-so-thoughtful risk-taking out there right now. Surveys show a big chunk of younger investors leaning hard into options, meme stocks, and borrowed money to try to get rich quick.
And we're really not here to wag a finger. Everybody runs their own race. But the one thing worth remembering, leverage is wonderful right up until it meets a bad day. The market dropping isn't the real danger. A drop landing on top of too much borrowed money is. Markets always eventually come back to the boring stuff, profits, cash flow, sane valuations. The hype is just the wrapping paper.
And just to make it concrete, regulators are getting a little twitchy about it. In one market overseas, officials are openly second-guessing whether they should have let people pile into single-stock leveraged funds after billions rushed in within weeks, mostly from everyday retail traders. It's the same human story every cycle. Social media makes everyone compare themselves to the global top 1%, so the urge to swing for the fences is everywhere. None of it changes the thesis. It just means the crowd is a bit more fragile than the chart makes it look.
All right, the week ahead. Tuesday, consumer confidence in the morning, FedEx after the close, Carnival before it. Wednesday's the big one for our story. Micron reports, a direct read on whether this memory boom is the real deal. And Thursday brings Core PCE, the Fed's favorite inflation gauge.
So the one-liner for June 22nd, a rotation, not a rout. The market paid the suppliers, doubted the spenders on thin breadth and month-end flows, with a quiet reminder that the suppliers still need those spenders' checks to clear. Whether today was a one-week wiggle or the start of something bigger is exactly what we'll keep testing together. Thanks for hanging out with us. We'll catch you on the next one. If this was useful, the best way to support the show is simple.
Follow or subscribe and turn on notifications. You will catch each new thesis check the moment it drops.
Share it with someone who thinks in frameworks too. And we read the comments, so tell us where we are wrong.
Thanks for listening. We will keep testing the theses in public.